All right. Hi, everyone. Welcome to today's webinar brought to you by Vantage Markets, where we'll be covering the final installation for Build Your Trading Strategy, where we'll be covering swing trading. Right. We'll be starting in a couple of minutes. So we'll just wait till 5 o'clock until everyone's tuned in. So do take note, we're streaming directly into the Vantage app as well as over Zoom. All right. So we'll start in a couple of minutes. All right. Hi, everyone. Welcome to today's webinar, where we'll be covering the final installation of Build Your Trading Strategy Part 3, where we'll be covering swing trading. All right. So we are streaming directly into the Vantage app as well as over Zoom. So do not hesitate to drop your questions at any point during this webinar. I just want to make sure you guys can hear me and see my screen as well. And yeah, I'll be monitoring the chat boxes as well. So do not hesitate to drop any questions at any point during today's webinar. All right, as usual, let's start things off with the disclaimer. I take note that the information, context, opinions which are expressed in the presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage and are solely used for educational purposes as they do not constitute investment advice and or consultation on how a client should trade. Also take note of the risk warning that comes with trading margin, forex and CFDs. They carry significant risk and is not suitable for all investors. You could lose substantially more than your initial investment. All right, so here's the agenda for today. Of course, we're going to be talking about swing trading. So, what is swing trading? We'll look at a simple definition of what it is and what whether and what type of time frames do we usually implement this strategy. And of course, with swing trading, you can go long and you can go short as well. Right. Okay. Then we'll also look at some of the typical swing trading indicators and chart patterns that we can use to help us identify potential reversal or turning points. And also we'll look at how fundamental data can act as catalysts for swing trading as well. And then of course we'll round up with a couple of examples of swing trading on the dollar index and as well as on the indices, the SP 500, which tracks the S&P 500 futures. All right, okay, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between Vantage Markets and Everest Fortune Group, where we've been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so let's just get going. What is swing trading? All right. Okay, so basically, it is a strategy that attempts to capture between short to medium term gains over a period for a few days to several weeks, right? So this can also, with swing trading, it can occur over a few days to a few weeks, and in some cases, it can even be months, right? So that's when it ends up actually being a longer term strategy as well, right? We're not looking for intraday reversals or swings, but rather the position is held at least for 2 to 3 days, right? is that so swing trading typically does not involve intraday it's not an intraday trading strategy, but it's a strategy that can last from a couple of days uh f- to a few days to up to 5 days and several weeks, and in some instances it can even last a few months as well. Right, so it's a trading technique that uses technical analysis to identify potential entry, exit, and stop loss levels or points based on significant swing highs and swing lows. So we'll also look at how to identify these significant swing highs and lows as well. In addition, fundamental analysis can also be utilized as an additional analysis tool, or it can be utilized as a catalyst as well. So you may already, for example, you may have already identified a swing high resistance, and you've already gone short after identifying that. But along the way, right, because it's a medium term strategy, right, it's a holding period over a few days to a few weeks. So maybe in a couple after a couple of days, you've taken the position, or perhaps even the next week, there is a data point that is released, and it is actually acting in your favor, right? So that data point is going to act as a catalyst to your trade, right? Okay, so what are some of the pros and cons of using swing trading strategy? Right. Okay. So swing trading requires less time to trade, obviously, because you're not spending everyday trading, right? If you're doing intraday trading, you'll be spending every day analyzing the charts and taking perhaps 2 to 3 positions every day. Whereas with swing trading, you're looking on a higher time frame. You'll be typically looking at the daily time frame or perhaps even the weekly time frame and trying to find and identify major swing high and swing resistance, swing lows and swing highs. And then once you have done the analysis, you'll probably put a buy order or sell limit order for that trade idea. And then and of course, you'll set your stop loss accordingly as well. And then you'll just wait for the market to hit your price. Okay. So it also maximizes short-term profit potential by capturing the bulk of market swings, because as we're looking for significant swing highs and lows, so the move between these two swings could potentially help us capture uh, a wider range in terms of profit, in terms of absolute terms as well as percentage terms. But of course, when it comes to swing trading, there's no way you can call the every single top and every single bottom to the exact T. So usually, even if you capture 50% of that move, that's actually very good. Right? Usually, I guess you'd probably capture about 30 to 40%, but anything above 40% of that entire move is actually a very good return as well. Right, swing traders can rely exclusively on technical analysis, which in a way simplifies the trading process because you don't need to look at the fundamental aspects and this and the technicals as well. So uh, if you as a trader or if anyone as a trader is not so comfortable with fundamental analysis or may not have time to analyze the fundamentals as well, swing trading is a strategy where you can purely rely exclusively on technical analysis to help you implement the strategy. Now, there's of course cons with every strategy, and and one of them that comes with swing trading is because you're holding the position for a longer period of time. So you're holding it overnight, you're holding it over the weekend or several weekends. So this in scenarios like this, your positions, whether long or short, are subjected to overnight and weekend market risk as well, especially with regards to the weekend risk, right? There's more higher risk when markets reopen on the following on a new week, right? Where you could have large gaps, as we've seen recently, for example, with gold and oil as well, right? And also we can have abrupt market reversals that can result in substantial losses. Well, actually, this part here can actually be mitigated if you have proper risk management process in place. So, like I mentioned at the start, anytime we've identified significant swing highs and swing lows, we must also identify the stop loss level as well, and not only identified as a absolute level, but also as a percentage of your trade and your total account size as well. And then once the position is in place, especially with swing trading, generally we will not use a fixed stop loss. You will actually use a trailing stop loss. So that way, as price moves in your favor, you are bringing your stop loss closer to your break even level, thereby minimizing any potential losses should price abruptly reverse. Right. And the last point is about swing traders often miss longer term trends in favor of short term market move. Well, this depends on whether you're doing swing trading over a few days, or 1 or 2 weeks versus swing trading over a few weeks to maybe a month or so, right? So it really depends on which time frame or which angle you're looking at it from. Right. Just checking if there's anything on. Okay, no, nothing in the comments so far. All right. Okay. So now we'll look at some of the typical swing trading indicators and chart patterns as well. All right. Some of the typical indicators that can be used for swing trading would be your moving averages, right? So this would be your 10-day moving averages, 20-day moving averages, 50, 100, 200. You can also use the golden crosses as well, the death cross, the golden cross, uh, when it comes to moving averages. And then you can also use Bollinger Bands, right? Bollinger Bands will help you define like the two standard deviation moves from the mean to the upside and downside to see whether uh, that instrument is potentially overbought or oversold. And of course, the 20-day moving average in that Bollinger Band also helps us to identify the trend as well. Right? If the 20-day moving day average is rising, then we can safely say that this is in a relatively strong bullish uptrend. And then if the 20-day moving average within the Bollinger Band is actually sloping down and falling, getting lower, we can confidently say that we're in a bearish trend. Then you also have the stochastic oscillators, which help us again identify overbought and oversold positions. So we'll be looking at a couple of examples of how we can use the Bollinger Bands and stochastic as well. And of course, we have relative strength index as well, RSI, that can also help us. It's another oscillator that helps us identify overbought, potential overbought and oversold positions. Another important aspect of swing trading is also being able to recognize chart patterns, right? There are various chart patterns that we that are commonly used in technical analysis, right? We have wedges, pennants, triangles, bearish channels, bullish channels, flags, right? So by being able to identify at least 2 to 3 important chart patterns and then combining it with the indicators that we have mentioned here. Okay, like I mentioned, I've mentioned 4 technical indicators here, but of course, these are not the only ones that you can use, right? These are the more common ones. And what is actually more important is using technical indicators that you actually understand. As a trader, it's important for you to know what technical indicators work for you and where it's actually played out in your actual trading experience, right? So that's actually more important to identify and understand technical indicators that you are that you understand, you're comfortable with, and you've actually seen the results when it comes to the actual trading uh, process. Right. Okay. Then also the second aspect of it is when you're able to combine your technical analysis with or rather combine technical analysis indicators with chart patterns, right? So we're going to see that in the examples as well. All right, okay, so these are some of the common chart patterns that we may see, right? So this is a triangle in this sense. This is a ascending triangle where you can see the horizontal part uh, is flat, so price is pushing against the resistance, right? Price is pushing against the resistance, but then you can see the slope is actually rising upwards. So its price is being restricted under a strong overlap or resistance level or strong horizontal resistance level, but price is actually making higher lows. So when you see uh, a chart pattern such as this, usually when it does break to the upside, it will actually trigger a strong move, a strong bullish move to for the bullish momentum to continue, right? So it's a combination when this is a ascending triangle. So you see a flat or horizontal resistance level where price is unable to break above it, but you see the triangle that is actually making a up or it's a rising slope. That means that price is making higher lows and is actually compressing, right? So price is actually compressing, and if it breaks to the upside, it is very likely to act as a bullish catalyst for further bullish momentum. right? And then similarly, this is this type of chart pattern. This is a falling wedge. Uh, so in a falling wedge, you see actually price compressing once again, right? The wedge is, or some would also call this as pendant as well, right? You can also identify this as a pendant as well, in a falling wedge or pendant. And as price descends lower, compresses, but when it breaks the upper trend line, it usually functions as uh, bullish, further bullish momentum. So this is actually falling wedges are seen when price has is starting to correct. So when after making a relatively strong move to the upside, and as price starts to retrace or correct a little bit, sometimes it will form a falling wedge, a pattern of a falling wedge, and then if the bullish momentum uh, is to continue, it will generally break out of this falling wedge and go higher. Similarly, you can also have a rising wedge. So in the rising wedge, um, right, in the rising wedge, oops, hang on. So in the rising wedge, you would see price actually, oops, pull back. Oh, sorry, uh, pull up after price has corrected. It pulls up and then finally breaks through. Right. Okay. So it's not the best one, but yeah, you can see how uh the the f- uh, the rising wedge would obviously naturally be the opposite of the falling wedge here. So when you see a rising wedge pattern, after price has fallen quite significantly, price retraces higher. It could form a rising wedge pattern, and then it should break underneath that lower trend line or the of that wedge, then it would trigger the next move down. Similarly, for the pendant is when you have price for the pendant. You can have price breaking to the downside or upside. So in some cases, pendant is also a pendant. It can also be called a symmetrical triangle where it's equal on both sides. So you see price converging into a narrow range, and then should it break to the upside or downside, it could potentially trigger the next move up. So symmetrical triangles or pendants uh, can trigger a move to the upside or downside, right? So that is more of a neutral chart pattern where a break to the either side of the triangle or the upper or lower trend line is likely to trigger the next move up. And of course, you have head and shoulders and inverse head and shoulders as well. So head and shoulders can be used to identify when a major support level is potentially going to be broken, and that you can use that to trigger a move. So you can see that price has formed a resistance here, where price has essentially made a significant swing high here, and then this is also a strong support level here where the shoulders is. So if price breaks through that shoulder level, it could trigger the next bearish move down. Right. So this is how we can use this is how we can use chart patterns to identify turning points or reversal points when it comes to swing trading. Right. Using fundamental data as catalyst. Right. So there's quite a few data events that you could use. We have inflation related data. So obviously, over the last 18 months or so, inflation data has acted as a very strong catalyst for the direction of currency markets, right? Because when inflation is rising, continues to rise higher. For example, in the USA, which was what was happening in 2022, the Federal Reserve is going to be aggressive and continue to raise interest rates. So when they raise interest rates, bond yields rise and the value of the US dollar also rise. And with the Federal Reserve being the most aggressive central bank in 2022 when it came to hiking rates, we saw a lot of inflows into the US dollar. So especially when inflation data continues to increase on a monthly basis, on an annualized basis, and especially if it comes in higher than the forecast every month, this is more than likely going to function as a bullish catalyst for the dollar index. Similarly, we are seeing the reverse happen in the for most parts of this year, where you've had where in instances where we had softer than expected inflation data, this has actually functioned as a bearish catalyst for the dollar index, because if the inflation data is coming in lower than the forecast on a monthly basis, on an annualized basis, this means that the Federal Reserve can afford to not raise interest rates. They can actually just maintain interest rates at the current level and perhaps even start cutting rates early next year, right? So when you have inflation data that is coming in softer or lower than the respective forecast, this can function as a bearish catalyst for the dollar index, right? Similarly, employment data as well, right? Employment data such as the non-farm payrolls, otherwise known as NFPs, they can be extremely market moving. So you can use these data points to for identifying potential catalysts as well, either to the upside or downside, right? So, for example, if you're already in a position prior to the NFP, you've already identified a strong swing high or swing low, and you've already entered that position, you can use the outcome of the NFP data uh, as a catalyst for your trade position. Now, of course, if that data point comes in your favor, great. That catalyst, that data point is going to act as a catalyst in the correct direction of your trade. But of course, if that data point comes in opposite to your position, and naturally that is going to impact your your trade your trade. So that definitely in that scenario, you should be looking to at least book profits early if you're already in profits, if you're already in the green, or if not, you should be looking to exit your position at a much earlier stage rather than waiting for it to hit your stop loss or your trailing stop loss, right? So fundamental data will naturally uh, can naturally aid your trade position when it comes to swing trading, or it can also be a big hindrance as well. So when the data works in your favor, whether it is long or short, then naturally you will try and ride the momentum as much as you can. However, if the data comes in opposite to what your position was, naturally that price is going to come come against you. So in that position, if you're already in the green, you should be looking to exit the position for a little bit of profit or for slightly lower amount of profit. And if you were in the red already, and price is and the cat data acts as a further negative impact on your position, you should be looking to exit the position early rather than waiting for it to hit your stop loss, right? We don't have to wait for positions to hit our stop loss to exit, especially when we know the fundamental data is going to act against our position. Right. And of course, as you mentioned, we had central bank actions as well. Hiking, cutting, intervention. These are all very important policy actions that central banks can take, right? And when they do uh, hike aggressively, like as what we saw with the Federal Reserve, we can see very strong movements in currency markets, and that's why you should take advantage of that. And it's also important to pay attention to what central banks are doing. All right, okay. So we're going to look at a couple of examples of swing trading. So we're going to look at the dollar index. Why the dollar index? Because that translates naturally into the euro, uh, the pound, dollar yen, and the Aussie and Kiwi as well. So once you know how the dollar index is trading, then naturally it translates accordingly to the other currency pairs. So if the dollar index is rising strongly, that means currency pairs such as the dollar yen, dollar franc will be rising aggressively as well. And that would also mean currency pairs such as the euro, the pound, the Aussie, and Kiwi will be falling sharply. Conversely, if the value of the dollar index is falling aggressively, that means currency pairs such as dollar yen, dollar franc will be falling. And of course, the opposite will happen for the euro, pound, and Aussie and Kiwi. All these four currencies will be rising, right? So that's why I'm going to use the dollar index as an example for swing trading. So then you can use the same techniques and the same indicators, or combine the indicators that I've shown you with your indicators and see and try and implement it on other currencies as well. All right. Okay. So in this examples that I'm going to present, okay, we're going to start off with the dollar index. I'm going to use the daily chart. And here I've used a combination of stochastics, right? And the Ichimoku cloud And you are able to see several chart patterns as well. We are able to see a descending trend line, falling flags, uh, horizontal or range bound trading as well, potential breakouts. And also we are able to see stochastics. For stochastics, I've used the indicators as 23.3, right? So for my smoothing, for the moving average, I'm using 20, and for the smoothing parameters, I'm using 3 and 3, right? So these are the parameters that I prefer to use for stochastic. As it helps me smooth out, filters out a lot of the noise when it comes to identifying the oversold and overbought position. And I like to use Ichimoku Cloud as well on the daily time frame because it helps to give you a good sense of where the general trend is for that particular instrument. And also the cloud can also offer help us to identify strong areas of support as well. So for those who may not be familiar with Ichimoku Cloud, uh, when the cloud is green, as you can see here, this part here, the cloud is green. So you can see the green line is actually above the red. So this means this is a green Ichimoku cloud. And when the cloud is green, this indicator tells us that the trend, the current trend for this index, or in this security, in this case the dollar index, is in a strong bullish trend. And especially when price is trading above it. So if it's a strong bullish trend, price is naturally going to be trading above the cloud. And as price pulls back in a bullish trend, the cloud will typically offer support areas as well. So we see that happening here in about June of 2022, and we see that happening again in August of 2022. So you can see that the Ichimoku cloud tells us that we're in a strong bullish trend, and as price was correcting, the cloud continued to offer strong support zones for uh, the dollar index. So we can use the combination of the cloud, the oversold stochastics, and are using chart patterns to identify potential swing ideas to the long side, right? So with central banks, or with the Federal Reserve raising interest rates very aggressively in 2022, uh, government bond yields in the US were rising strongly, and also the value of the US dollar was rising very strongly as well. So if the value of the US dollar is rising strongly versus its peers, naturally the dollar index is going to rise as well. So you can see that dollar index here was range bound trading over a few weeks, and then when stochastic reversed to come higher and it broke above what was close to 100, it triggered the next strong move up, right? So you can see that price was range bound trading here over several weeks. So when you look at charts on a daily time frame, you're able to identify chart patterns. So we know that in this scenario, this was a um, range bound trading, and as stochastics reverse and started to move higher, and we see price breaking above the upper trend line or the upper bound, this triggers a bullish move as well. So this was a bullish breakout for the dollar index, right? Then as price began correcting, naturally in any up bullish move, price is bound to correct itself as part of how financial markets work, right? Nothing moves up in a straight line, goes down in a straight line. There's always retracements to the upside and to the downside. So as price was correcting here in June, and the dollar index was correcting quite strongly, we also saw stochastics reverse and turn. This would have also been a potential area to short as well as swing trading, because you can also see that this would have. Oh wait, let me change this to. Right, let me change this to red so it's easier to. Right, so previously, hang on. Right, sorry. Right, so price previously ran into a little bit of resistance here before breaking higher. But then after that, when price broke above this overlap resistance here, we can also see that the stochastics turned lower as well. So stochastics were indicating overbought position for quite some time. But of course, we cannot just rely on a single indicator to short a current to short any instrument. You have to wait. You have to combine the indicator with other indicators, or use chart patterns to help you identify a potential reversal as well. So you could see this was previously a swing, an overlap or pullback resistance level, which price broke above it, but then price made a swing high here, and then went and started to pull back. And as it broke through the previous resistance level, right, this previous resistance level would now be support. As it breaks through the support level, and you also see stochastics turning lower and going under 80, this would also trigger. This is also telling us potentially this is a a very strong, giving us a strong indication that this is a potential bearish move down lower to the downside. So when price breaks through the support level after making the swing high here, we see stochastic turning lower, then we can initiate or start a short swing trading position here. And of course, we can use the oversold uh, uh, region of the stochastic indicator to help us identify uh, the potential take profit area for or take profit level for the short position. Similarly, we can also use the cloud as well. As I mentioned earlier, the Ichimoku cloud will offer or will typically offer strong support zones. So you can use the combination of where the cloud is just above the cloud and where stochastics start to indicate oversold position. That's where you can potentially start to exit the position as well. Right. So this is how we can use uh, chart patterns, stochastics, and strong overlaps and resistance to identify this was for bearish reversal. Similarly, as price made or stochastic showed us an oversold position and then started to move up, right? Then stochastic started to move up, climbing above 20, right? And we also see price finding support above the cloud. This is now then identifying, highlighting to us a potential swing to the upside, right? So previously we had the swing to the downside here, and now we have the swing to the upside here, led by a combination of price finding support above the Ichimoku cloud, combined with stochastic uh, moving above 20, climbing or moving away from the oversold position. Plus, you also have price breaking out of the bearish channel, right? So you had a strong bearish channel here, and as price found support, above the cloud, price breaking through the bearish channel, and with stochastics also moving away from oversold positions and climbing above 20. We have three indicators that are telling us that this is a potential swing low, and this is a good opportunity for us to go long on the dollar index. Right, and similarly, after price comes here, right, price this was price comes into oversold uh, over rather overbought position here. Stochastic is telling us it's coming into overbought position, and then as we see price retreat from this position here, we could also potentially use this to help to initiate a short position as well, and where you would target the profit would be, in this case, slightly just above where the where the Ichimoku cloud is. In this case, stochastic didn't pull back all the way down as what we saw in June. So that is why sometimes you cannot just use a single indicator. Right? In this case, we had a combination of the oversold, stochastic, and price finding support above the Ichimoku cloud. In this case, price found support above the Ichimoku cloud, but it did stochastics didn't drop all the way down to oversold position. And also, if we look here, we'd also see a descending trend line here, right? We see price forming a price trading under the descending trend line. Then, as price found support above the Ichimoku cloud, it broke through the uh, descending trend line, and we also see stochastics turning higher as well. So we have three indicators telling us that, okay, now that price has broken out, this is very likely going to initiate a strong, or you're going to trigger a strong bullish move to the upside. So we have another swing position here that we could have capitalized on for the long side. Right. So see, once again, we're looking at chart patterns. So when I do it on the daily time frame, I prefer when I do swing trade. For me personally, when I swing trade, I use the daily time frame because that's where I'm able to identify key chart patterns, and also I can see where the major oversold and overbought positions are. So that's what this is the time frame that I typically use. So similarly here, price found support above the Ichimoku cloud, and as price and we can see a descending triangle form as well, or descending trend line form as well. And as price broke through the descending trend line, we know that price has already found support above the cloud, and we also see stochastics turning up again. Stochastic didn't continue down, but actually stochastics continued to go higher. So this triggers the next bullish move to the upside. Similarly here, price that failed to break above the swing high here, right? So this is already giving us a major resistance level. We also see stochastics reaching oversold position. And as stochastics turn lower, moving from overbought and dropping below the 80 level, we can also see price has continues to fall as well. Right. So we can also identify ascending trend line as well, right? If we look at this here, probably price is also making an ascending trend line here, right? It's not the best trend line. That's why I didn't draw it in the chart originally. But you can see that after making this swing high here, stochastics also indicated overbought position. And as stochastic turned lower, price failed to make a new high, and also price broke through the ascending trend line, triggering the next move down as well. So in this case, stochastic did fall all the way down close to 20, or to the oversold position. And also we saw price coming very close to find support once again above the bullish Ichimoku cloud. So this is how we can use uh, the stochastics, the swing high, and the ascending trend line here to identify the swing, a potential swing short position, trade idea for the dollar index here. Similarly, as price stochastics indicate oversold positions here, and price also finds support at the Ichimoku cloud, or just above the Ichimoku cloud. We can see then price breaking above the bearish channel, right? So this would then trigger the next bullish move to the upside, right? So here we can see price breaking higher. So again, we're using stochastics that have reversed off oversold positions to move higher. We can see price has found support at the Ichimoku cloud, or close to within the Ichimoku cloud. And also we see price breaking above the bearish channel, which then gives us a strong confirmation, or strong uh, indicator, or combination of strong indicators tell us that, right, the swing low has been formed and price is breaking out to make a new, or breaking out, and the bullish momentum is likely to continue. Right, so this is how we can identify the reversals here. Now, similarly, as price goes higher, we see stochastic reaching overbought position, but here price failed to break above this level here. And then we can also see price as it's moving higher here. There is a case for ascending trend line here. You can see price failed to break above the swing high here. Then price broke through the ascending trend line, and also we see stochastic turning lower as well. That also allows us to take on a short swing trading position here. Although this pullback wasn't as strong, but you can see that most of the, because we were in a strong bullish trend, the only well, not the only one, the for most parts of 2022, the strongest retracement came in June, whereas the other retracements were not as strong. Or sorry, the strongest retracements came in June and in August, whereas the other retracements or pullbacks were not as deep as the ones I have mentioned earlier. Right. So similarly here, right, price fails to break above this level at 115. We can also see stochastics being in overbought positions and start to turn lower. And also you can see price breaking through, failing to break above and turning lower. So this also gives us an indication that this is a potential swing reversal taking place, and we can take a short position on the dollar index here. Right, and then this is quite important here, right? This, when price moves through the bullish Ichimoku cloud, that's what we see here. This indicates a major potential reversal in trend. So like I said, the Ichimoku cloud tells us that price is currently in a strong bullish trend, and usually price finds support at the cloud, just above the cloud or within the cloud. But if the cloud fails to provide support to the instrument, or in this case dollar index, and the dollar index is cleanly broken through the bullish Ichimoku cloud, this usually signals a strong reversal in price action. So that means this now is telling us that the strong bullish trend for the dollar index is over, and now we should actually be uh, we are actually now entering the start of a potential bearish trend for the dollar index, right? So in this case, you can see as price trades underneath the bearish Ichimoku cloud. Do take note now that price is trading underneath the cloud. So now this is a very bearish trend, and then you would try and identify those potential swings as well. So you can see here, although the stochastic didn't reach, is the thing about stochastics, it's all about uh relative performance, because usually when price does go above 80, it does signal overbought position, and when this indicator goes under 20, it does indicate over sold positions. But also we have to also try and recognize the relative performance or the levels as well. So we can see here, when price made this when stochastic came up here and started to reverse, that was also when this down move came. Similarly here, price touched the upper trend line of the bearish channel, but failed to break above it and started to reverse. And we also see stochastic turning lower as well. So that's when you should be initiating another short position as well. And not only that, not only have I identified the bearish channel as well, if you're able to see, there's also uh, a bearish flag as well. You can see price breaking through the bearish flag here, breaking through another bearish flag here to trigger the move to the downside as well. And then of course, once you can see here price now, stochastics being in oversold positions, indicating oversold position, but starts to rise strongly here. And also with price cleanly breaking above the upper trend line of the bearish channel, this signals a potential move to the upside as well. And then also price was breaking through the Ichimoku cloud as well. So this is also another breakout in the chart pattern that's supported by stochastics turning higher, moving away from the oversold position and rising strongly, and also price rising up strongly as well, indicating a strong bullish momentum or breakout or swing trading position as well for the long side. Right, now this is for 2023, or the second part. So again, as price broke through the Ichimoku cloud, this time the momentum failed to continue. Price actually reversed, and actually, if you look at this part here, you can also see price sort of trading within the channel as well. And as the lower trend line of the channel got broken, you see stochastics also turning lower and dropping sharply. This is also indicating a potential uh, short trade as well. And of course, you can see price failed to break above this swing high here. You can see stochastics turning lower strongly. So this would indicate a potential short swing trade as well. So just checking if there's any questions coming in on the app. Okay, so far no. All right, okay. Then over here we do see stochastics indicating oversold positions, but price never really uh, made the move higher. So that is why sometimes that is why I always stress that you cannot use any indicator or any chart pattern by itself. You have to combine at least one or two to three indicators perhaps, or one or two together with being able to identify chart patterns and identifying the potential breakouts to the upside or downside. So here we can see stochastics turning higher, rising sharply. This was a bearish channel as well. And as price broke above this bearish channel, it signaled the next move up as well. And similarly here, with stochastics indicating overbought positions, we see price fail to break above what is about 102, 100, yeah, about 105 maybe. Yeah, price failed to break above this. You can see it's sort of like making a head and shoulders pattern, and then as price broke underneath the shoulder, and of course with stochastics turning low as well, this also then signals the next swing trade for the short side as well. Right, so you can see the examples here of how we can use the combination of stochastic indicators, Ichimoku cloud, and using chart patterns to help us identify potential high potential swing reversals, right? So whether this could be bullish reversals or bearish reversals. And for stochastic, for Ichimoku cloud, I've just used the default settings. There's no customization of the parameters for Ichimoku Cloud. But for stochastics, I prefer to use 20 for the moving average for the length, and the value 3 for the smoothing parameters. Right. So the next I'm going to look at the S&P 500 or the SP 500. So this is a instrument that tracks the S&P 500 futures. So for this, I've used a combination of Bollinger Bands with the 20-day moving average in the orange line, stochastic, same parameters as before, 23.3. But I've also used another indicator. In this case, I've used well, not really an indicator, but another index to complement the analysis. So in this case, I've used the volatility index on the VIX. Now, for those who may not be familiar with the VIX, it is a measure, it's an indicator that measures the value of volatility in equity markets in the US. So the VIX is rising sharply. That indicates volatility is increasing in markets, and that usually means equity markets are pulling back. So over the last 18 months or so, when the VIX has crossed above 30, that has usually indicated a potential bottom for the S&P 500. Now, of course, you cannot just use the VIX in isolation. So that is why I've used it, combined it together with the stochastics and looking at Bollinger Bands as well. So here you can see in February or towards the end of January, the VIX going above 30, probably going as high as maybe, I'm not too sure what it is, probably about 35, 36. We can also see the stochastics indicating oversold position, and we can also see price is actually pushing very strongly against the bottom of the, or pushing strongly against the lower bound of the Bollinger Band. So these three indicators are telling me that, right, okay, now we have a potential scenario for, there's a high probability for a potential short-term bottom to be formed for the S&P 500, and we can potentially take a swing trade to the long side here. Similarly here, you can see it happened here in towards the end of Feb and early March as well, right? Although the move in early March uh, did not trigger a sustained move to the upside, but you can see in March here, the move was definitely much stronger. So once again, you can see VIX climbing above 30, and as VIX starts to retreat, uh, price starts to move higher. You can also see stochastics coming very close to oversold positions and then moving up higher. And of course, you can see price pushing against the lower bound of the Bollinger Band. And as price moves up, bounces off the lower bound and crosses the 20-day moving average, signaling a very strong potential move to the upside. So this is how we can use the combination of the VIX, stochastic, and the Bollinger Bands to identify potential bullish reversals or swing low reversals for the S&P 500. Now, of course, with any strategy or analysis, it never works 100% of the time. That is why I said risk management is always important. to identifying risk management is always important before you identify any positions, be it to the short or long side, right? So similarly here, towards the end of June, once again with stochastics being indicating oversold positions, VIX rising above 30 and starting to retreat, price pushing against the lower bound of the Bollinger Band as price retreats away from the lower bound. We see the stochastics also moving higher. We also see the VIX retreating. So that also indicates a potential uh, reversal for the S&P 500, potentially forming a short-term bottom here before price moved higher. Right. So similarly here, you can say that, okay, this didn't count because although stochastics did indicate oversold position, the VIX was still under 30. So wouldn't have used, at least I wouldn't have used this to identify a potential bottom here. I would actually prefer to use the VIX. I would like to see the VIX come up to go past 30 and then retreat. And then, of course, look at stochastics indicating oversold position, and similarly looking at the price bouncing off the lower bound of the Bollinger Band. So you can see in October, price actually formed this double bottom here, right, with VIX making a double top, right? And before VIX started to retreat quite sharply, and you can obviously naturally see here stochastics turning up, rising quite strongly, and also price crossing over the 20-day moving average to go higher as well. So this is how we can use the combination of the VIX, stochastics, Bollinger Bands to identify high probability short-term bounces for the S&P 500. Now this is for 2023. So similarly here, all right, okay, although here, all right, okay, price didn't, the VIX, sorry, not price, VIX didn't reach 30. So, sorry, apologies for this. This line shouldn't be here, right? Because what we're looking for is for VIX to climb above 30 to signal a potential, to give us a indicator that's going to indicate a high probability short-term bounce for the S&P 500. So this is what we saw in March, right? So in March, we had the regional banking crisis. So we had volatility pick up. We saw equity markets pull back. So when VIX went briefly touched 30, in this scenario, VIX didn't go higher than 30, but it did briefly touch 30, and as it started to retreat, we also see stochastics moving away from oversold positions to rise strongly. We also see price bouncing off the lower bound of the Bollinger Band to eventually cross the 20-day moving average and climb higher. And so this is how we can use the combination of the VIX, stochastics, and Bollinger Bands for the S&P 500. All right, okay. Oh yes, and this is okay. It's the same thing. So here, all right, these lines are highlighted in green, but we can see here in this case that VIX didn't reach 30. So I'm less inclined to use uh this to identify potential short-term bounces as well. Although you can see it did play out very nicely here in May, and less so in August. So that's why I like to use the combination of when VIX is actually pushes past 30, stochastics are oversold, and price bounces off the lower bound of the Bollinger Band. That usually signals a high probability short-term bounce for the S&P 500. All right, okay. So I've come towards the end of today's analysis. Of today's webinar. If you have any questions, please do drop them now. I can clarify anything as well. If you'd like me to repeat anything or go through anything else, please do not hesitate to drop any questions now. I'm also going to launch a poll for those who are on Zoom. I can really appreciate it if you can give your feedback here. And also do look out for all upcoming webinars by Vantage and do register for them as well. All right. Okay. So, right. Okay. So if there's no further questions or queries, right? Thank you for tuning in to today's webinar, where we're concluding the final part of build your trading strategy. All right. Thank you, everyone. Have a great trading week.